Hi, hi, good evening, everyone. I'm James, the speaker tonight, and the market strategist here at Tiger Brokers Singapore. So again, this is a three-part series where I talk about the equity market, covering stocks, ETFs, and other products listed on SGX. This is part two of the three-part SGX series. The next one, the final one, will be conducted about 1 month later. So tonight topic is SGS series building a resilient dividend focused portfolio. The stocks I cover today are all dividend paying stocks itself. Okay, let me go through the disclaimer first. This presentation is provided to you for education and sharing purpose only, and it does not constitute to any form of advice. Past performance is not indicative of future performance. Okay, before we begin the equity outlook, I would spend a little bit of time to talk about our SG60 campaign. So to celebrate SG60, we are giving out some attractive rewards to our customers. Firstly, Tiger Brokers is waiving the Singapore stock custody fee for all account types. Previously, there was a $2 custody fee per quarter, but this will now be waived until further notice. You do not need to do anything. The waiver will be applied automatically to all accounts. Secondly, we are offering zero commissions on all SGX stocks from now until 17 October. Basically, you can then trade SGX listed stocks, ETF, DLC, SDRs, commission free until 17 October. To enjoy this promotion, simply log in and open the event page on your app. You can find this in the profile tab. It's one of the rolling banner itself. So once you tap the banner, the SGX commission-free rewards will be credited to your accounts. Then you go to the reward tab to activate it and start trading commission-free for your SGX trade itself. Other than the commission-free promotions, Tiger Brokers will also be rewarding the top 100 traders with the highest points during this campaign period. So as long as you trade Singapore listed securities with a buy amount of at least $1,000, you stand a chance to win prices ranging from $60 to $3,800. Okay, let me quickly explain how these points are calculated. For every qualifying buy trade of 1,000 Sing dollars or more, you will earn 1 point. The more qualifying buy trades you make, the more points you accumulate. So the higher your chances of ranking in the top 100 itself. Here are some of the prices for the top traders. First place will win a MacBook Pro worth around 3,800. Second place will get an iPhone 16 Pro Max. Third place will receive an iPad. And traders rank 51 to 100 will get $60 cash voucher each. You will be automatically registered for the campaign once you open up the event page itself, just like I showed you earlier. Okay, lastly, we are also running a weekly ranking campaign itself. So each week, the top 50 traders with the highest points can win prizes ranging from $5 to $20 in the cash vouchers. Again, the qualifying trades are SGX listed securities with a trade value of at least $1,000 itself. Okay, um, each qualified trade will be counted as 1 point. However, if you want to earn double points during the campaign, there are certain specific counters that will count as 2 points. You can find these double point stocks in the double points counter list when you scroll down the event page itself. Alternatively, you can also find the list in the terms and conditions located at the top right corner of the event page. Okay. So other than that, Tiger Brokers now supports CPF and SRS investments via Cash Boost account. To find out more, please go to the profile tab and tap on the banner itself. There you will see the current promotions we are offering and instruction on how to link your Cash Boost account with CPF or SRS. But first, please ensure that you already have an existing CPF IA or SRS account with DBS, OCBC, or UOB before linking. Okay. So here you can see how to link your CPF or SRS account. You can enjoy 6 months of commission-free tradings once you link it. Uh, Upon your first CPF or SRS trade, you will also be awarded approximately $20 worth of STI ETF shares itself. Okay, that's all about it. So let me start with the 2025 outlook itself. Okay, the STI remains one of the top performing stock indices globally so far this year. We could see that the year-to-date return is about 15%. It once came down as much as 15% in April itself, but it has now recovered strongly and now is trading near its all-time high. 2025 looks likely to become the fifth consecutive year of positive returns. So, and if you compare the STI with other indices in terms of the 5-year annualized performance, the STI returned 15.5%. S&P 500 also returned about 15.52%, but the Hang Seng Index only returned 3.55% itself. Okay. Singapore is a trade-oriented economy. So a global economic and trade slowdown itself will definitely hurt the Singapore economy. But it seems like there is lesser recession risk in the US or China compared to half a year ago. So the concerns about trade slowdown at the moment are not as worrisome. I would say that the investor sentiment is doing a lot better now. But if we look at the export numbers, Singapore exports slumped 4.6% in July, worse than expected. The 3-month moving average increased by just 1% in July. And this was much lower than the 7% increase in June itself. Singapore exports to US also fell by 43%, mainly due to a drop in the pharmaceutical shipment itself. And even though the US only imposed a 10% tariff on Singapore, US importers may be taking a cautious stance and may be scaling back orders first. So this is why you see a drop. At this moment, Enterprise Singapore in data is projecting export growth in 2025 to be in the range of 1% to 3%. So it's look like the export figures for the remainder of the year will remain challenging. Okay, GDP growth looks quite decent this year. The MTI has upgraded Singapore economic growth for 2025 to be between 1.5% and 2.5% from 0% and 2% itself. I think what has also been supporting this year's stock market rally is the whitening market breadth, meaning the STI is not only being lifted by banking stocks, but also by other sectors, other small mid-cap companies rising in prices itself. So this all indicate a healthier stock market. We could also see that the corporate earnings have also been resilient. And there are also some MAS-led initiative to um, revitalize the local stock market, which have improved investor sentiment itself. Okay, I want to briefly talk about the MAS initiative. Okay, in February, MAS announced several measures to strengthen the competitiveness of Singapore equity market. They focus on mainly three areas: demand, supply, regulatory. And I'm not going to talk about all of them. Okay, the demand side is to improve the investors' interest and market liquidity. Supply side is to attract the quality listings. Regulatory is to streamline the framework and strengthen the investor confidence. Um, right now, market participants are mostly excited about a demand side measure itself. So one of the most important initiative that we have all heard is the 5 billion uh, equity market development program. So MAS will allocate 5 billion through selected fund managers to actively invest in the Singapore listed equities itself with a focus beyond just large cap index stocks. So in the first phase, the 1.1 billion has already been deployed to asset managers, including Avanda, Fullerton, and JP Morgan. A second round of selections and capital deployment is expected to uh, be happening later this year. So I would say retail investor or a lot of investors are quite excited about the news itself because they are now speculating on which small and mid-cap companies could benefit from this 5 billion fund flow itself. Okay, other demand side measures include tax exemptions for fund managers, adjustment to the GIP and the GEMS research grant scheme itself. Okay, I'm not going to talk about that. Okay, I want to look at seasonality. So the STI index has risen 15% so far this year. But I think that some investors are still quite under-invested and their portfolio have not gained as much as 15% so far this year. So if you are still under-invested, the next question you should be asking is that when will we see a correction? When is the better market timing to accumulate in the market itself? So if we look at the past 20 years average monthly performance, we could see that August and October typically see some corrections. On average, August returned negative 3%, and October returned negative 0.5%. But as of today, I think as of 2 days ago, August is up by about 0.33%. So this also suggests to you that maybe seasonality does not work this year itself. Um, Regardless, one of the key takeaway is that November and December are usually positive months with average return of 1.1% and 1.3% respectively. So overall, I would say that the STI may deliver positive returns closer to year end, especially November and December, because of window dressing and the Santa Claus rally itself. Also, some investor, uh, including both retail and institutional, may be lagging behind the STI performance itself. So as year end approaches, they may take on more risks. They may take on a riskier stance by investing more to make up for the lost performance itself. Okay, here is the list of the 30 STI component stocks as of August 19 itself. it show each company weightage in the STI index, the yearly return, I mean the 2025 year-to-date return, the 3-year, 5-year, 10-year annualized return, and the dividend yield itself. This is trailing 12-month dividend yield. Okay, and bear in mind that this 30 STI component stocks can earn you double points because they are part of the double points counter list in our SG60 promotions Tiger Brokers itself. For example, if you trade DBS, you can earn 2 points with a buy amount of more than $1,000 instead of just 1 point under the SG60 campaign itself. Okay, and also bear in mind that all the return you see here, right, already included the dividend yield itself. For example, the year-to-date return of 19.4% by DBS already included the dividend payout received so far this year itself. Okay. Okay, now a few important notes on this slide itself. Number one, all STI stocks pay dividend. So if you are looking to build a dividend portfolio with companies that have good track record, these 30 STI component stocks are a good starting point. Secondly, the banking stocks have shown all of us strong long-term performance itself, outperforming the STI index. Okay, in terms of the 10-year annualized performance, DBS is at 15.4%, OCBC is 10%, UOB is 10%, while the STI index is only at 6.4%. So this is about 9 percentage points below the DBS return itself. And keep in mind that the 3 local bank stocks make up 51% of the STI index weight. So if banks continue to outperform, it will be difficult for most investors to beat the benchmark STI performance. Having said that, if you really want to outperform STI, there are 2 ways. Number one, you could overweight the banks. You could probably hold more than 51% in the bank stocks itself. For example, you can hold 60% or 70% or even more if you are that constructive on banks. But if banks continue to outperform, your portfolio return will outperform STI because of the higher weightage in banks. Number two, you could underweight banks. You can hold less than 51%. Maybe you can just hold 20% or maybe just hold 30% itself. But then you need to ensure that other stocks in your portfolio can really outperform banks. And so far, the second method has worked quite well this year. For example, the year-to-date returns for OCBC and UOB are 6.8%, sorry, 6.2% and 2.3%. But other stocks have done relatively much better. For example, if we were to look at Jardine Madison, it returns 50% so far this year. SD Engineering returned about 74% so far this year. Hong Kong Land is up by 37%, UOL is up by 44%, and DFI Retail is up by 59% so far this year. So if you overweight these relatively smaller cap companies instead of banks so far this year, your portfolio may have outperformed the STI this year itself. Okay, the third key takes away is that the defensive sectors like REITs within the 30 component stocks have shown you mixed performance. But the outlook going forward should improve because of the potential rate cuts itself, because REITs benefit from rate cuts. And we could also see that back in April, REITs were mostly down even though there are some rate cut expectation itself. But I would say that the narrative back then, back in April, was that the Federal Reserve may cut rates to prevent a recession. But now fewer people are talking about recession risk. So this is why REITs are probably doing quite okay now. Just remember that REITs are quite vulnerable in a recessionary scenario. Weaker economy means weaker demand, lower occupancy rate, lower rental income, and lower asset values. So as long as the Federal Reserve is cutting rates because of subdued inflation and not because of the recession fears, REITs should be okay. Okay. And okay, now let's talk about interest rates. Okay, a lot of Singapore stocks are paying dividends, so it's important to understand the movement of interest rates. To put it simply, as long as interest rates are coming down, dividend paying companies will remain attractive as long as they can maintain the same dividend yield. And remember, all 30 component stocks pay dividend. Uh, and this is mainly because that investors are getting a relatively higher dividend yield compared to a risky asset like a government bond or the FD itself. Okay, basically the interest rates in Singapore are quite correlated to the Fed fund rates. So if the Federal Reserve cut rates, Singapore interest rates should be coming down. The Federal Reserve looks at two things to decide whether to cut rates: the labor market and the inflation number. US inflation has generally um, come in cooler than expected if you take into account all the past few months data itself. The labor market in US is probably weaker than expected. Basically, if you still remember Beveridge curve, the Beveridge curve suggests that if the job vacancy continue to fall, basically the unemployment rates may increase significantly itself. So because of maybe weakening labor market, the Federal Reserve may need to cut rates soon. Okay, the future market is now suggesting that we could be seeing two rate cuts in 2025 and three rate cuts in 2026 itself. Okay, the rate cut expectation is similar to the rate cut expectations 1 month ago. And I think that the speed and the magnitude of the rate cuts make sense, but the rate cut expectation may change after Friday or Saturday because of the Jackson Hole meeting itself, where Jerome Powell will be speaking. Generally, I would say that US is overdue for a rate cut. However, however, when US cuts rates, Singapore interest rates probably won't drop as much. Okay, so when US cut rates in September, Singapore interest rate maybe will not be dropping much uh, as expected because the solar has already been dropping quite a lot since mid 2024 itself. Here I am showing you the DBS share price performance and the 3-month compounded solar. So from the movement of solar, it represented in white line itself, we can actually see that it moved down quite sharply uh, before the Federal Reserve cut rates. So uh, and generally solar is moving ahead of the Fed fund rates uh, itself. Okay, the traditional wisdom is that when Singapore interest rates like solar come down, banks, local banks will face net interest margin compression, which should hurt their share prices. For example, whenever Sora came down, DBS prices follow in uh, 2007 and 2019 as well. But since solar has been coming down from 2023, the DBS stock price has generally been trending upward. And we could also see other banks like DBS, sorry, OCBC and UOB share prices have also been trending up during this period itself. So why is that so? I think it's probably a combination of reasons pushing up bank stock prices, mm, namely better non-interest income from faster growth in the wealth management business, slower provision for loan losses, faster deposit growth that help reduce DBS cost of fund. Lastly, multiple expansion itself, like the PB ratio expansions itself. Okay, okay, and I also want to show you that DBS stock price goes up before solar start trending up. Okay, so DBS stock price tend to move first before solar even moving up. But this information to you is probably a bit irrelevant now, but it will come in handy few years down the road itself. Okay, I also want to briefly talk about REITs. Okay, basically lower interest rates are constructive for REITs, and it looks like Federal Reserve will start to lower interest rates meaningfully. And this has revised some of the REITs performance uh, itself. So lower interest rates are basically good for REITs because firstly, lower financing costs means that REITs manager can refinance loan or take up new loan at a lower financing cost. Secondly, we may see higher property prices due to increased demand. Thirdly, we may see more acquisition to grow the DPU. Fourthly, lower interest rate will make the relatively higher dividend yield generated by REITs more attractive. Okay, this is a chart that I showed last year. So the asset date is September 8th, last year itself. Basically, what it means is that whenever the spread between the 10-year bond yield uh, represented in blue line and the REITs dividend yield represented in the purple line is wide enough, then REITs should represented in orange, yellow line itself should start to outperform. So the logic here is that if 10-year bond yield only gives the investor low yield, then investor might as well just invest in REITs to earn a better dividend yield itself. Personally, I think the magic number is 3%. Or whenever the spread is wide enough, uh, like 3%, REITs should start to provide higher return itself. Okay, here we could see that during the April crash, uh, the spread was about 3.13%. And since then, the REITs start to, uh, in yellow line, start to go up in prices itself. What is even more important is that even though the REITs has gone up a lot since April, the spread at the moment is still um, quite wide enough. It's still at 3.225%, suggesting that there may be more room for REITs prices to go up itself. Okay, other than that, the valuations for REITs look inexpensive. If we were to look at the PB ratio, it is trading at 0.915 3 sorry, is the PB ratio is now trading at 0.93 times itself. Okay, which is about one standard deviation below the 25-year mean. Okay, so should there be a mean reversion, the PB ratio can probably go up to the 25-year average at about one times itself. If there is more optimism, it may even go up to this level at 1.1 time, which is one standard deviation above the 25-year mean. Okay, so it all depends on the market sentiment itself. Okay, here I want to show you the REITs and the REITs ETF listed on the SGS itself. They include the CSOP, IH, S-REIT, Lion, uh, S-REIT ETF, UOB APAC Green uh, REITs ETF, okay, and CICT Digital Core REITs, just to name a few. So again, these are all the counters uh, that could earn you double points in our SG60 campaign itself. Okay, and here show you the return, year-to-date return, 3-year, 5-year, 10-year annualized return, and the trailing 12 months dividend yield itself. The rule of thumb is that you should research on some of the outperforming ones like CICT before even looking at the laggards itself. Um, I think it's best to understand why the outperformance are outperforming. Then you can research on why the laggards is lagging behind and to see whether they are being misjudged by the market itself or not. Okay, I probably give you a few seconds to screenshot the performance here before moving to the next page. Okay, here are the remaining REITs listed on SGX. Again, I won't spend time on this, but I would like to urge you to look at the performance before even looking at the dividend yield. Okay, bear in mind that the return here already included the dividend returns. So, and I would urge all the investor to emphasize on the total returns instead of just the dividend yield. Okay. Okay, these are other dividend yielding securities listed on SGX, just to name a few. So they include STI ETF, Lion OCBC APAC Financial, Singapore Bond ETF, Ping An SDR, HSBC SDR, Bank of China SDR as well. So if you were to invest in this SDR, you also will be getting some dividend itself. On a side note, uh, yeah, all company I show today will earn you double points. Okay, now let's talk about dividend investing. So, why dividend investing matters? Firstly, regular passive incomes. So dividends provide you a steady cash flow, which could potentially supplement your monthly pay and retirement income as well. Secondly, lower volatility and stability. So dividend paying companies are usually quite established and less volatile. Thirdly, inflation hedge. Fourthly, downside cushion. Dividend return could help you cushion your portfolio ups and downs. Signal of financial health. So consistent dividends show that a company has strong cash flow because dividend come from cash flow. And it also show you the company has confidence in the long-term performance as well. Okay, lastly, favorable tax treatment. Singapore dividends are tax exempt due to the one-tier taxation system, itself making them more attractive to the investors. So in contrast, if you were to look at the US listed companies, those typically are paying lower dividends, like Apple counter like paying maybe less than 1% dividend itself. And on top of that, a foreign investor will face a 30% withholding tax on the dividend payout itself. So this is what makes Singapore dividend stocks more appealing. Okay, I want to share more about this dividend portfolio example itself. So the portfolio, okay, this is the portfolio, dividend portfolio example itself. So this portfolio returned 28% in 2024 and 25% in year to date itself. So beating STI 18% and 16% during the same period. Okay, so bear in mind that this is just a mock up. This is just an example. Okay, so uh, basically some of the assumption would be number one, it only rebalance once per year. It rebalance once at the end of the year itself to the original weightage that show here itself. Okay, so and some portfolio traits include firstly, the portfolio dividend yield was just 4.7%. So it's slightly above the STI index 4.2% itself. So many of you may think that this is not a lot, but I guess this is a trade-off between the portfolio returns and the dividend yield itself. So again, if you have been investing long enough, you will know that sometimes good companies does not pay high dividend yield uh, itself. And I value portfolio total return more than the dividend itself. Okay. Secondly, the bank stocks account for about 48% of the portfolio weight. Okay, the reason why I still like banks is because I reckon winners keep winning. So I reckon the long-term outperformance of bank stocks will continue. And if you include the APEC financial ETF here as part of the banking weight, uh, it will be a total of 54% in the banks itself. Okay. Thirdly, I also include about 5% weight in the ABF Singapore Bond Index ETF. Okay. And I believe that a lot of investors may not have this bond ETF because of the low 2% dividend yield. But I think this could be acting as one of the good asset allocation tool. If there is a market crash scenario, you can deploy the 5% into the equity market itself. Okay. But bear in mind that if I remember correctly, the 10-year annualized return for this ABF Singapore bond ETF is only 2.3%. Okay, so again, it's not a lot. Having said that, it's not going to boost your portfolio returns by much. So I will probably treat this bond ETF as money on the sideline, ready to be utilized whenever there is a correction itself. Okay, lastly, REITs such as CICT, Fraser Centrepoint Trust, Parkway Life REITs account for about 18% of the portfolio weight itself. So yeah, this is about it. Okay, I actually prepared some slides about some of the individual counters, but probably I won't spend time on this because I feel that most of the information already been known to the market itself, so I don't think I can add anything new to that. But if you have any questions, please do ask. Okay, so um, thank you. We shall move on to the Q&A sessions. So if you have Any questions, please type in the Q&A box itself. And if you are listening to this webinar via the Tiger Live app, please also type in your question uh, itself. Okay, let me drink some water. Okay, probably I read out some of the questions from the Tiger Life. Okay, the first question is, despite uh there is no capital gain tax in Singapore, still not much inflow of foreign funds. Am I right? Um, I think if you were to look at the market cap size of Singapore market, and compare it to the global equity markets, I think the market cap or the AUM of all Singapore stocks only accounts for about 2%, if I'm not mistaken, but definitely less than 5% of the uh, total weight of the market cap of the global equity market itself. So if you were to ask me whether there are a lot in flow, typically, traditionally, that is not a lot if you compare to other market. But I would say that it's picking up. I would say that if a market consecutively provide investor maybe 5 consecutive years of outperformance, positive returns, this will attract some interest into investing in Singapore market itself. But probably I also come from a global fund manager point of view. I would say that when global fund manager look at Singapore equity market itself, right, they typically will look at it as, okay, good dividend paying, um, fairly value, uh, compared to the regional indices itself. So they would always think that Singapore is more of a value play, defensive play. So sometimes if they want to risk off, they would probably want to allocate some in the Singapore markets as some of the safe haven asset allocations. But if they want to look for growth stocks, they would typically look outside Singapore because there are much more high growing growth stocks, maybe in US or maybe in Hong Kong, China itself. So personally thinking, I would say that if you were to look at some of the SGS initiative in recent years, is that they have been bringing in some of the Hong Kong SDR, Thailand SDR, and you can also see SocGen is also issuing some of the Max 7 DLC itself. So I would say that uh, if you view that there is lack of growth stocks listed in Singapore market itself, because again, it's more of a defensive play, uh, uh, some of the SDR, Max 7 DLCs, right, offer you some of the growth stock play uh, itself that you can probably trade in the Singapore dollar currency. Okay, so I would say that this is some of the way that you assess the market itself. Um, okay, so the next question is that in a lower interest rate environment, would bank return be challenged? Yes. Okay, so if the interest rate keep on going down, you will be seeing NIM compressions, just like the slides I showed you earlier itself. Okay, but the thing is that with lower interest rate environments, it should also spur loan growth, or maybe because of conducive, uh, good economic outlook, the provision for loan losses will be lesser and lesser or even stabilize itself. So you cannot straight away say that because of NIM compressions, definitely bank stock will be hurt. Okay, so the current environment is that there are other businesses like the wealth business that is keep on growing. And then some of the bank stock here are also try to expand the market, try to expand the total addressable market by venturing overseas and also
Recording stopped.
acquiring
Recording in progress.
acquiring other banks in the region as well. So I think this could actually increase the total addressable market. So this is why you have been seeing some PB expansion, especially happening in the DBS itself. Okay, so yeah, this is why there is multiple expansions. Okay, if is this session recorded? Yes, this session is recorded. Okay, let me go back to the Zoom and answer some of the question first. Okay, can we get a copy of the slides and transcript? No. Okay, this is a good question. Is DBS overpriced? Depend on how you look at it. If you are a traditional value investor, and you believe in mean reversion, then DBS is probably trading at a historical high PB ratio that you will deem expensive. But also bear in mind that why DBS trading at such a premium valuation itself, because maybe it's just worth it. Maybe of the acquisitions, maybe of some of the business growth itself, maybe because of some of the business initiative, maybe because they always give upside surprise in terms of bonus share or even the dividend itself. So I would say that uh, it's fairly value. Uh, um, is it overpriced? I don't really think so. Okay, yeah. Do you have the recorded videos kept somewhere to be shared? So if you are, you just go to the Tiger app and go to live, and then you can see all the past live webinar itself, including this one. Okay. Um. Okay. Let me try to look at all the REITs name. CP. Okay, is REITs ETF, for example, CFA REITs a good buy? Um, I would say that if you were to look at the, okay, so this is Nicole AM, Asia S Japan REITs, if I'm not mistaken. So if you were to look at the long-term performance, it's not doing quite well. Okay, I do not understand the REITs so much, but since it's the Asia S Japan REITs itself, I would say that it probably include one of the biggest Asia Pac REITs that is listed in Hong Kong, which is the Link REIT itself. And I have not monitored that stock in long enough, but I think some of the underperformance was dragged down by Link REITs uh, itself. And at this moment, I don't have a good understanding of Link REITs, and I believe Link REIT is included in the Asia as Japan read. So you need to form a view that whether you still like uh, some of the Hong Kong listed REITs inside here, especially Link REIT itself. Okay, but if you were to ask me, is REITs ETF uh, some of the good choices itself? I would say that um, it depends, okay, on how you view it, because it actually offer you some diversified choices itself. So they include industrial hospitality uh, itself. But again, you also know that some of the individual REITs itself are not that performing. So if you are quite savvy with the sector, maybe you are and then you research good enough, you can just venture into investing in those individual REITs. But for general investor, if you don't have much knowledge of the individual sectors itself, right, REITs ETFs are some of the good choices for you to gain exposure to the REITs itself as a whole. Okay, if US cut rates, will Singapore banks share price be adversely affected? Um, okay, again, let me probably repeat some of the key takeaway that I shared just now. Um, 3 month solar has already been coming down by a lot. So if you were to ask me, it has already been affecting those bank stock NIM. However, even being affected, we can see that Singapore banks are holding up, or we could see that DBS is doing especially still quite well this year itself. So they are cutting rates not to prevent recessions. They are cutting rate is because that they see subdue inflation itself. So if you say that US is having a recession or China is having a recession, then it will adversely impact probably Singapore banks because it's a cyclical play, you see. Okay. And I would say that bank stocks has probably priced in a few US rate cuts. This is why solar has been coming down. So if you were to look at the past history, you compare the Fed fund rate versus the SORA or in the past SIBOR itself, you will know that sometimes SIBOR will just come down and hit the bottom before US Fed fund rate come down and hit the bottom itself. So sometimes it's just this is how the solar works itself. So even if US start to cut rates, right, probably you won't see a drastic fall in the solar itself that will continue to hurt the NIM net interest margin of the Singapore banks. Okay, so this is my thinking itself, or at least even though a lot of investors are quite worried about NIM itself, right, we are not really seeing that impacted the market quite a lot so far this year itself. Okay, so is CICT one of the good REITs to invest? Okay, unfortunately, I don't have CICT here, but yes, good office prime locations, good retail mall asset locations itself. I like the property locations. Um, yeah. Okay, so 12-month dividend yield is not the full year dividends, right? How come CFA so low, like below 3%? Okay, I get all these numbers, right, from the Bloomberg data itself. So even though they take in trailing 12 months itself, right, maybe the calculation could be a bit wrong sometime. Okay. So depending on how they read it sometime, but the best way for you to calculate is that if you want to calculate yourself, you just get the past 1 year dividend payout divide by the current share price. Then, yeah, so this will be it. Okay, STI price is at the peak. If market crash, what stocks or bond can use for defensive purpose? So if you are really seeing a market crash scenario, um, and you want some defensive play, right? The one that I could think about is probably Sheng because consumer staple play. REITs, um, okay, REITs itself are branded as defensive play. But again, I would like to argue that if market crash and if this is a recession scenario, REITs will not be spared. Okay. So I probably won't include REITs for defensive purpose if in a recessionary scenario. Um, in the market crash, not because of the recession, then maybe REITs is a defensive play. Bond is like the ABF Singapore Bond Index ETF itself could be one of the better play because of the low correlation to the Singapore equity market itself. Okay. Um, Other than that, off the top of my mind, I can't think of many uh itself. Maybe I like Fraser Centrepoint Trust as a defensive play as well. Yeah. Okay, so this is again a good questions. So maybe I want to bring you back to the previous slides. Okay, so the question is STI has been underperforming for a long time, past 20 years, and only did well in the past few years. Is the current uptrend sustainable? Okay, depend on what you compare it with. If you are comparing STI with other global indices, yeah, in the past 20 years, we take about 10 years to go past 3,900. Uh, the first 3,900 was obtained in 2008, 2009 itself. So we take about 10 years time to go back up to the previous peak. So compared to maybe US market, we are underperforming. Um, STI does not underperform some of the stocks here, okay? But it has underperformed the bank stocks. So if you compare to the bank stocks, yes, it has been underperforming uh, itself. So sometimes uh, maybe bank stocks is also a better play compared to owning the STI index ETF itself. Is the current uptrend sustainable? I would say that if you ask me in the beginning of this year, I would say maybe not. But if you were to ask me now, I would say that maybe yes. Why is that so? It's because I see widening market breadth. Okay, for the past 2 years, I would say that the index performance, the STI performance was probably mainly lifted up by the bank stock itself. But if you were to see what is happening this year, a lot of sectors has been coming up in prices. Okay, uh, it's not just bank stocks. Bank stock just maintaining there and then up by a bit like OCBC, UOB. But other stocks are really seeing good performance, then they have been lifting up the STI itself. So widening market breadth equals to uh, healthier markets. This is similar to 2007, 2008 itself. And okay, I'm quite old, if you can tell. I lived through 2007, 2008. In 2000, 2008, a lot of sectors, a lot of stocks are going up in prices. And there's a phrase called feel good factor. I don't know whether you remember that or not. So, uh, feel good factor is something like consumer sentiments or similar to animal spirit in US itself. And I can tell you that if you live through 2007, 2008, there is really feel good factors in the market. And there are some feel-good factors nowadays, even though media don't say feel-good factors anymore. Okay, so I would say that the investor sentiments is super important, and I'm feeling that at the moment. Okay, so is the uptrend sustainable? Probably yes, because I don't see a recessionary scenario happening soon. I still see more upside for the US market itself. And because of that, we should be doing along quite okay. uh, itself. Yeah. Okay, let me go back to the Tiger Life and see whether there's some questions. Okay. Okay, is there a fund to invest in the Singapore dividend portfolio? The Singapore dividend portfolio that I show you is just a mock up. It's just a example. Okay, it's not like someone is managing it or not. So if you are interested in that, you can just take a page from the see some reference from the dividend portfolio itself and maybe do some research and do your own discretions whether to invest or not. Why the solar is not meaningful to the retail now? Please expand. I didn't say the solar is not important. I'm just saying the solar, right, has already come down a lot. So when the Federal Reserve cutting rates, the solar may be trending sharply, or larger than expected anymore because it has been trending down quite a lot. What this? Okay, how would one decide on the correct entry price for dividend paying stocks? If enters too high, may result in capital loss instead. I think this apply to all. The market timing is always difficult, not only for dividend paying stock, for every stock is also quite difficult. So if you have trouble in market timing like me, uh, you may want to spread out your investment itself by slowly accumulate, not to go in one lump sum at one go. You can just adopt the dollar cost averaging method by going in stages, spread out your investment. Instead of putting in 12,000 right now, you can spread out 1,000 investment per month for the next 12 months itself. Okay, I'm hoping Tiger can give up lots to buy SGS shares. Um, because 100 shares of DBS is quite unaffordable. Okay, I understand. We will definitely feedback. Um, okay, this is an interesting question for REITs with high proportion of debt in fixed rate. Will the recovery be slower? I think it depends on individual basis itself. Because again, even though it's fixed debt rate, it depends on what fixed rate they set in, and also it depend on the maturity date itself. So if it mature sooner, like a lot in this year, so when the interest rate keep on coming down, then they already matured and then they can refinance at the lower rate. So it depends on individual basis. You need to look at the maturity date, the average maturity rate, something like that. Okay, some questions I don't quite get it. Um, oh, okay, how about the dividend stocks in the Hong Kong market? I would say that yeah, there are some interesting ones that listed here, like the STR, so like HSBC, Bank of China, they also give quite good dividend itself. So it depends on whether you like the Hong Kong bank stocks STR that listed here. Okay, which is your favorite data center REITs? I don't have an opinion on data center REITs, unfortunately. I probably don't understand enough to really like data center REITs. So for the past few years, it doesn't really come into my radar, unfortunately. Um, okay, okay, why is MLT and MIT performing so badly? Why does the Industrial Trust and Logistics Trust of Mapletree performing so badly? Unfortunately, I don't have an answer for that. I don't study them good enough because Logistic Trust and Industrial Trust, I'm not really familiar with that. So sometimes if I'm not familiar, I just don't understand them enough to really like them. Okay, and to find out more. Okay, how high can DBS go and how high STI can go? Um, okay, I don't have an answer for that. I think STI to me, if you look at chart wise, maybe another 10% upside from here. Chart wise, okay, technical analysis, how high DBS can go. I don't have an answer for that. You can look at other analysts' target price to see whether you can form an opinion or not. I don't recently look at chart and see how high DBS can go. But against, you probably also need to understand that DBS is going higher also because of the picture they portray, the narrative they portray itself. Um, the revenue growth is so far meet expectation or uh, beating the expectation. So this is why I think a lot of investors are still fond of the DBS stock itself. I don't exactly have a target price as of now. Yeah. Okay, is UOB a good buy in view that the dividend yield among all the three Singapore banks is considered high based on the 12 months analysis? Okay, to be honest, right, I if you ask my personal preference is that maybe I like DBS the most because of the narrative, because of the management, because of the long-term outperformance itself. UOB and OCBC to me is probably about the same. When you do talk to retail investor or institutional investor, you do find out that um, all these three banks, right, they they also like, okay, so I would say that they don't have the preference. Okay, to me, you will find them liking equally, like each of them equally. Okay, so they will have their own reason of liking them itself. But if you were to ask me, probably I like DBS the most. UOB or OCBC to me is probably about the same. They all have their own Asia, China story to go on uh, itself. Do you think it's the start of a multi-year bull run for Hong Kong China markets? It's a super interesting questions. I do not know whether it's a multiple year bull run for Hong Kong China market or not. I do like to say that if you were to look at the economic numbers, GDP, uh, household income, um, inflations, some or M2, M1, the number are sometimes uneven. So I would still expecting an uneven recovery story for China, Hong Kong itself. If you were to look at the housing prices, it's still dropping. So that is a bit worrisome to me. Um, I would, okay, let me face it this way. Personally, I think US equity market will outperform China, Hong Kong in longer term. But when I say that, I would say that probably in longer term, US equity market will return maybe, uh, for example, just for example, maybe 10%, but it doesn't mean that Hong Kong, China will return negatively in longer term. I'm saying that probably when US return 10%, China, Hong Kong will return 5 or 6% or 2 or 3% uh, itself, okay, but will underperform the US equity markets. Okay, and I say that mainly because of the total addressable market itself. So I do view that US equity market or the US company have a larger total addressable markets. Okay, let me go back to the Tiger Life and try to answer some questions. Okay. Okay, there's a lot of question about bank stocks. Bank stocks outperformance due to the high interest rate environment. The interest rate is actually coming down. They are still outperforming. Is the narrative of the outperformance still valid? Uh, yes, in the sense, um, yeah, you can see that banking stock long-term wise, again, if you were to look at here, 3 year, 5 years, or 10 years, right? Typically, they outperform the STI index, or typically they outperform some of the stocks here. So the outperformance is still valid in the sense, NIM compression probably hurt OCBC and UOB. I mean, the narrative itself lah, probably hurt these two banks more than DBS. DBS got another narrative to go on itself. But long-term wise, I like all of them. Okay, so um, yeah. So okay, any inputs on ST engineering is down by more than 6%. Any bounce back confidence in near term? I I think sometimes when it actually return quite a lot, like more than 80% at one point. So now go back to only up by 70 something percent is normal. Normal. The world favor defense play at the moment. So there are some fund flow into some of the China defense play or overseas defense play or even the US defense play. Defense play have been gaining some traction itself. So I would probably brand this more of the fund flow play, and but we also do see good profitability itself. But so again, if you were to ask me, I am constructive in the long term. Wise, short term wise, I do not know whether this is the bottom or not. Yeah. Okay. How to check the points accumulated? Let me revert to you by answering in the live uh, webinar. I mean, the webinar replay in the Tiger app. Okay. I will remember to reply you. Okay. Okay, some of the questions I don't have an answer like right now, but I will try to answer them. Okay, because it's quite some of them are really individual stocks that I do not look at them much. So I do not want to give you a half-baked answer right now. Okay, okay, I think I have answered most of them. Some answer really don't have, I mean, some question I really don't have an answer because it's some of it's individual names that I don't research much to have an opinion right now. Okay, if there is no more questions, we will stop now. And again, thank you all for attending to this webinar. Our final part of this series will be about 1 month later. Okay, I thank you, everyone. I hope you all have a good investment journey, trading journey ahead. Happy investing, happy trading. Thank you, and I shall see you soon. Thank you.